Hello. Welcome to In 180 Seconds. Today, we will learn what is a put option in trading. Option is a contract between a buyer and a seller. The contract talks about trading a stock at a predetermined price called the strike price and has an expiry date. The buyer who is interested buys the option for a small fee, also called as the option premium. Now let us look at a real-world example. Let us choose Infosys as our stock. It is currently trading around Rs 1,400. Let's assume David thinks the price of Infosys could go down drastically by the end of the month, say below 1,200. At the same time, Peter might have a different opinion and feels the stock might stay at the current price, or even appreciate from here and go up. So Peter writes a contract. The contract says, the current price of Infosys is Rs 1,400, but I can give you the right to sell Infosys share for Rs 1,300 by the end of this month. Here the end of the month is treated as the date when this contract expires. And the Rs 1,300 at which the option contract written by Peter is called the strike price of the option. Okay. But in order to give you the right to sell it at Rs 1,300 by end of this month, you need to pay me a fee of Rs 10 per share of Infosys. This is called the option premium. Also remember the option or contract is done on a lot size of a stock. This lot size varies for each stock. The lot size for Infosys as of today is 600. So David could trade a minimum of 600 stocks or in multiples of it in options. So the total option premium that David is willing to pay would become Rs 6,000. So who gets the profit? Peter, the seller of the contract, would be happy if the price of Infosys stays anywhere above 1,300. He will get to keep the 6,000 fee he collected from David. And David loses that money. Now, if the price of Infosys share goes to Rs 1,200 by expiry, then Peter is obligated to give the right for the 600 shares of Infosys to David, to sell them at a price of Rs 1,300, although the current market price is Rs 1,200. So Peter bears the difference. Which means he would end up with a loss of 1,300 minus 1,200 for each share of Infosys. Remember the deal was done on a one lot of Infosys. So the total loss would be Rs 60,000. However, the premium of Rs 6,000 he received from David is his money. So the effective loss is Rs 54,000. And this Rs 54,000 is the profit David gets for doing that option trade. As you could see, by the expiry date of the contract, these are some of the possible profit and loss scenarios. Take a pause and absorb it to get a better hang of it. The loss for Peter is unlimited and the maximum loss for David is the premium he paid, which is Rs 6,000. One thing to note is David need not hold the put option until the expiry of the contract. Between the time he bought the put option and the expiry date of the contract, David could freely sell this put option in the market to someone else at a different price. Hope this is clear. So here comes the definition. A put option gives buyer the right, but not the obligation, to sell a stock at a specified price within a specific time period. The buyer of the put option profits when the underlying stock decreases in price. And the opposite of this is the call option. The link for this can be found in the description. That's all for now, thanks for watching. Goodbye.